Hi everybody, welcome to another update on the stock screener. We have a new challenger from Altrunar, and that's Tenaz Energy. They acquire assets and they have this oil producing asset in Canada. So let's see what this company is doing. But first, why do we invest in natural gas? Because of the EV boom, because of the EU-US arbitrage in gas, oil is going to transition into natural gas consumption, and the arbitrage is going to close between US and EU gas. Now, let's take a look at the charts. Pieridae Energy has been going up, and Tenaz Energy has been going down. So, yeah, based on this performance alone, I'm questioning what's happening at Tenaz Energy. You could say maybe this is a buying opportunity, but let's dive into the numbers. Okay, so Tenaz Energy, a very small company, 40 million market cap, about 6 times smaller than Pieridae Energy. So that means there is more risk involved. PE ratio is actually higher than Pieridae Energy, so it's already overvalued. So let's see if they can grow production. Maybe there's growth. Ratios, 80% gas here, and here only 40% gas. So we need to use the oil price here. Production is much lower, about 20 times, 30 times lower. So very small production. So that's why market cap is also lower. Has no debt, so that's at least good. There's less default risk. But of course, Pieridae Energy has more financial leverage as it pays off the debt. I couldn't find decline rates, but it was conventional oil, so that's typically low capex. But even then, we see 17 million in the capital budget, which means they want to grow very fast. Because 17 million is very high for such a small company. Operating costs are high because, yeah, it's low in production and they have high administrative costs. So I put it on high costs. So it doesn't look very good already. Free cash flow is negative, and that's because capex is very high. So they're trying to grow as fast as they can by drilling a lot of wells. So every money that they get, they are putting back into the ground, and yeah, it's very risky because they are probably going to dilute shareholders at some point. Tax pools, couldn't find any. Reserves, I only found the 2P reserves, which are pretty high, so they have a lot of property to drill. Can be good, but can also be bad because you need a lot of capex to do that. Royalty was very high, so less upside on leverage. 22% royalty. Let's look at the leverage chart. So you can see here at current $80 oil, the capex is too high. So they have negative free cash flow and they need at least $100 oil to go above the zero line. So very negative here. Even at $160 oil, which equals the 10 ICO gas price, they would have a double in upside. But at Pieridae, we have 15x upside. So yeah, this is a very easy one. Tenaz Energy is a no-go for me. Less leverage, less free cash flow, higher royalties, costs, no tax pools, also high operating costs, no financial leverage, low production, higher PE ratio, small cap, higher risk. So yeah, I'm sorry to say, but Pieridae Energy is multiple times better than Tenaz Energy. So I will await our next competitor and see you in the next video.